Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today, on November 28, 2025, we're diving deep into Meta Platforms, ticker symbol Meta. There has been a whirlwind of news surrounding the company lately, and we're going to break down what it all means and then tie it directly into what we're seeing on the charts. First, let's talk about the headlines because they are game changers. The biggest piece of news is the report that Meta is exploring a massive, multi-billion-dollar deal to purchase AI chips, specifically tensor processing units or TPUs, from Alphabet. This is huge because Meta and Google are direct competitors, and this move signals a major strategic shift for Meta. For years, Meta has been one of Nvidia's largest customers, so this potential diversification could significantly impact Nvidia's market dominance and pricing power, which is why we saw Nvidia's stock fall on the news. This is seen as a long-term positive for Meta, as it could lead to lower costs for its massive AI infrastructure build-out. However, this brings us to the other side of the coin, the sheer cost of this AI arms race. Wall Street has been growing increasingly concerned about Meta's capital expenditures, which are projected to be enormous, without a clear, immediate path to monetization like rivals Amazon and Google have with their cloud platforms. These concerns were amplified when Meta's stock came under heavy pressure earlier in the month, with some analysts noting the company's rising investment cycle may not generate strong enough returns. Adding to the uncertainty, Meta's chief revenue officer recently departed the company. And if that wasn't enough, Meta is also facing legal headwinds in Europe. A court in Spain recently ordered the company to pay nearly €500 million to Spanish news outlets for unfair competition and GDPR violations, a ruling that could set a precedent across the EU. So we have this fundamental battle playing out. A very strong core advertising business versus massive spending on AI and growing regulatory risks. Now, let's see how all this turmoil is reflected in the long-term price action on the daily chart. Looking at the past year, we can clearly see a powerful uptrend that carried the stock to its 52-week high of $796 back in August. That peak represents a major resistance level and a psychological barrier for the stock. Following that high, the stock entered a significant correction phase, falling for several months. A key event we need to analyze is the Q3 earnings report from late October. Despite strong revenue growth, Meta reported a huge earnings per share miss due to a one-time tax charge, and its forward guidance wasn't enough to excite investors. This event created a massive bearish gap down on the chart, which is a significant technical event that traders watch closely. The stock plummeted from around the $750 level, opening near $670 the next day and continuing to fall. This shows how a negative fundamental catalyst can completely reverse short-term sentiment. After that dramatic drop, the price found a bottom and began to consolidate, establishing a new critical support zone. The area between $580 and $600 has acted as a floor throughout November, representing a key level where buyers have consistently stepped in. Let's zoom in on this recent, volatile period to get a better look at the battle between buyers and sellers. We are now looking at the daily chart from late October through today. You can see the enormous red candle on October 30th, which confirmed the breakdown after the earnings report. That created a huge price gap between roughly $670 and $750, and filling that gap will be a major objective for the bulls. Following the drop, the price chopped around, eventually finding its footing and bouncing off the sub-$600 level multiple times in mid-November. Then, on November 24th and 25th, we see the reaction to the Google AI chip news. Notice the two very strong green candles with significant volume, propelling the stock from the $590s to over $630. This was a clear bullish catalyst that broke the stock out of its recent consolidation range. The price is now trading around $633 to $641, which puts it right at another interesting technical spot. This level acted as a consolidation area back in December of last year, so it could now serve as resistance. We are currently seeing the price pause right at this potential resistance zone. Switching over to the hourly chart gives us a more granular view of this recent breakout. Here we can see the powerful gap up on November 25th very clearly. Since that explosive move, the price action has been much tighter, indicating consolidation. The stock appears to be building a base or forming a flag pattern right above the breakout level. Immediate support on this time frame appears to be around the $630 level, which has been tested a few times in the last couple of days. Resistance is at the recent highs near $638, and a sustained move above that could signal the next leg up. This type of consolidation after a strong rally is often healthy and can be bullish, as it allows the stock to digest its gains before continuing the trend. However, if it fails to hold the $630 support, it could be a sign of weakness and might lead to a retest of lower levels, possibly around the $615 to $620 area where the gap began. Now, for the very short-term picture, let's look at the 15-minute chart for the last two trading sessions. Yesterday, we saw the stock close at $633.61 after a relatively quiet day. Today's pre-market activity has pushed the price up towards that $641 mark. The price action is contained within a fairly tight range, which reinforces the idea of consolidation we saw on the hourly chart. Traders will be watching for a high-volume breakout above this range, say above $642, as a signal to go long, or a high-volume breakdown below support at $630 as a signal to go short. The lack of significant selling pressure after the recent run-up is a positive sign for the bulls in the immediate term. It suggests that holders of the stock are not rushing to take profits just yet. Volume will be key today. A breakout on low volume is less convincing than one on high volume. So, let's pull back to the daily chart and summarize what we're looking at. There are several key price levels to keep on your radar. Critical resistance is the current zone around $640. A decisive break above this level could initiate the next major move higher. The first target for bulls would be the psychological level of $650, followed by the challenge of filling that massive post-earnings gap, with targets at $670 and eventually $700. On the downside, immediate support lies at $630, with a more significant support zone between $615 and $620. The most critical, must-hold support level in the medium term is the $580 to $600 range, which marked the November low. A break below that would be a very bearish signal and could open the door to a much deeper correction. So, what are the potential scenarios? The bullish scenario, which I believe has about a 70% probability if we can break $642 with conviction, is that the positive sentiment from the Google deal continues to drive the stock higher. In this case, we would expect a gradual move to start filling that gap towards $670 and above. This would be reinforced by any positive news regarding Meta's AI monetization strategy or a dovish tilt from the Federal Reserve in December. The bearish scenario, with about a 30% probability, would see the stock fail at this $640 resistance. If concerns about spending and legal issues resurface, or if the broader market turns sour, we could see a retreat to test the $600 support level. A break below $600 would significantly increase the odds of further downside. Things to watch for are any official announcements confirming the AI chip deal, the company's next capital expenditure guidance, and, of course, overall market sentiment. Keep a close eye on volume during any breakout or breakdown attempt. That's our in-depth look at Meta for today. To recap, watch for a breakout above $640 for a bullish continuation, or a breakdown below $615 for a potential bearish reversal. Thank you for joining us here on Explain the Charts. Before you go, please remember that this video is for informational and educational purposes only and does not constitute financial advice. Trading and investing involve risk, and you should always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Don't forget to like and subscribe for more detailed chart breakdowns. We'll see you in the next one.